Hello and welcome back to Chapter 12 Notes. And so in the prior lecture video, we talked about NOPAT. And so now what we're going to do is we're going to talk about the denominator for the return on investment calculation, which is invested capital. So there are a couple different ways to measure quote-unquote invested capital. Common approaches would be total assets minus current liabilities. Or what we're going to do is total assets less non-interest-bearing current liabilities, such as accounts payable. So non-interest bearing current liabilities, such as accounts payable, don't have any interest, and so we would subtract them from our invested capital because since they don't carry any interest expense, we would consider them a free source of funds, and so that's why some companies choose to subtract that, and that's the approach that we'll use as well in this chapter. So you come over here. The one thing to keep in mind is that we're using the book value of our assets. And so you may or may not recall that book value is the original cost of the assets minus the accumulated depreciation. So if you think about it, and we thought back about maybe the way to increase ROI would be to decrease the use of your invested capital. By decreasing the denominator of the invested capital, the ROI calculation will go up. So what's one way to do that? Well, to continue using your existing assets to generate net income. Because as you use these assets over time and don't purchase new assets, the book value will decrease because accumulated depreciation will continue, which pushes down the book value, and then you take your book value less your non-interest current liabilities, and this number goes down, which means this number goes down as the denominator for the return on investment calculation goes down. The return on investment will then go up. Okay, and that's something we'll talk about over here in a few minutes. Maybe that's one problem with using return on investment as a performance measure. So let's go ahead and take a look at this example that we have here and go through and calculate NOPAT and calculate invested capital, and then finally take our NOPAT divided by our invested capital to calculate our return on investment. So Davenport Mills is a division of Iowa Woolen Products. For the most recent year, Davenport had net income of $20 million. Included in this income was interest expense, $1.4 million. The tax rate is 40%. The total assets are $235, current liabilities of $52 million, and then 36 of those 52 are non-interest bearing current liabilities. So let's calculate out NOPAT, invested capital, return on investment. So NOPAT, recall what we'll do is the first thing is we're going to take our net income. And so in this case, right, we're not given income from operations, so we have to go through and calculate it. So remember, this is our net operating profit after taxes. So we're only given net income, and then we're given the interest expense, okay? But we can back into figuring out NOPAT, which is what we were talking about earlier on that other page, in the prior video. So we take our net income of $20 million, and we say plus our interest expense, okay, which is given to us at $1,400,000, okay, and of course that will give us our $21,400,000. That would be the total, and then we're going to do is say less tax savings from interest expense. So remember, we have to take out that tax savings from the interest expense, which is going to be equal to our $560,000, which is, and I'll just write it over here. The way I calculated that is I'll take my 1.4 million times my 0.4. Okay, and so what I get over here, my NOPAT will therefore be equal to my $20,840,000. Right? So then I come over here and I calculate out my invested capital. And all I have to do is take my assets, the book value, remember this is the book value of the assets, the 235, minus my non-interest bearing current liabilities, which is given to me at 36 million. So when we do the math, we get 199. Then to calculate ROI, we take NOPAT divided by my 199, which gives me my 10.47%. That would be my return on investment. And then I could use that to compare that against other divisions of Iowa Woolen Products to see how they're doing. I could compare that against the cost of capital to see if this division, their ROI of 10.47% is higher than our cost of capital, and if so, that's a good thing. If not, that's a problem, right? So I guess what I'm trying to say is without further information, I can't really say whether 10.47 is a good return on investment or a subpar return on investment, okay? So when we talk about some problems with return on investment, first one is that invested capital is typically based upon book value, it's based upon historical costs. And so what we say, again, what I was talking about earlier, is we take our original asset cost minus the accumulated depreciation. That gives us the book value. Over years, accumulated depreciation will go up, which means the book value of those assets will go down. And so that's what we're saying over here. Fully depreciated assets are going to lead to low invested capital, which inflates the return on investment. So it can make the comparison investment centers using ROI a little bit different because they could have assets that are at different stages in their useful life. Okay? And as a result of this, if you hold managers accountable for ROI, they may put off the purchase of new equipment because remember, if we're using the historical cost, the book value, they could say, well, I don't want to buy any more equipment. I don't want to buy any new assets. And by doing that, I can decrease invested capital, which increases return on investment. If we talk about evaluating managers with profit, and here I'm saying profit, not return on investment, that could lead to overinvestment, which is one of the reasons that you would want to look at ROI. Because if you just hold managers accountable for profit, they can continue to invest in assets. They can continue to get new equipment, which then could help them increase their profitability. But we're not measuring how well are they using their assets to generate profit. Okay. Finally, and then this is what we were talking about over here, using ROI could lead to underinvestment because what we said over here, we're using that historical cost, and so they could just drive down the denominator by using older equipment, which then increases the return on investment. And we could also say managers may not take on projects that have low ROI just to increase profit if they are evaluated in terms of the return that they earn. And managers of investment centers with high ROIs already may be unwilling to invest in assets that return that's satisfactory to upper level management, but would pull down their own division's ROI. So from an upper level management, they say that ROI is good, but the manager of the division is saying the ROI, while you think it's good, it's not as good as what I'm already doing, so I don't want to do it because you're holding me accountable for ROI. Okay. Finally, if we look over here, we can talk about residual income. That's the next thing that I want to talk about. Right? So when we talk about residual income, we're going to be talking about our net operating profit after taxes in investment center, what they earn in terms of their NOPAT, in excess of what they should be earning. So I often kind of look at residual income as a form of variance analysis. That's what it looks like to me when I think about it. Okay? So what we're saying is, here's what you did earn versus what should you have earned. Okay? So if we look at that, we take our NOPAT minus our required profit. So when we think about what is our required profit, that becomes the real question, right? But we look over here and our required profit is going to be equal to the cost of capital that we have times our total assets, the book value, minus our non-interest bearing current liabilities. So basically, we take the cost of capital, our required rate of return, times our invested capital. That's the required profit. That's what we should be earning. And then we compare that against the actual NOPAT. And if NOPAT, our actual NOPAT, is higher than what we should be earning in terms of our required profit, then that's a good thing. If it's lower, then that's a bad thing. Okay? So let's look at see two more examples over here of calculating out NOPAT and looking also at residual income. So when we first look at this first problem, okay, let me just catch up here. When we look at this first problem, we'll say, and what might be a good idea is that you pause the video and go ahead and do this problem, and then do this problem, this example residual problem, and then come back and check it, okay? All right, so I'm going to go ahead and review the answers to these two problems. So if we look over here, we look at the first one, we have our sales less our cost of goods sold, less our selling and admin expenses, less our interest expenses gives us our income before taxes, and then we have our income taxes and we have our net income. We have our total assets, we have our non-interest bearing current liabilities, and here's our cost of capital. Calculate NOPAT, invested capital, and return on investment. So we look over here and we look at the solution. The first thing that you actually have to do, because this one's a little bit trickier, is you actually have to calculate the tax rate. And you may have had a few problems with that, although we did talk about that in the first lecture video where we talked about how to calculate NOPAT, and I said, see, we had to calculate the actual the tax rate by taking your income taxes as a percentage of your, in this case, we have to take our income taxes as a percentage of our income before taxes to figure out what the tax rate is. Okay? So if we look over here, we say we're going to take our net income, which is given to us at the $6,435,000 plus the $1 million of interest expense times, in this case, and we're just going to multiply it times 1 minus the tax rate. So what you could have done, and this is the way I did the problem of the Davenport Mills, is I said, here's my net income plus the interest expense less the tax savings, which is 35% of that. Mathematically, that's the same thing as saying your net income plus your 1 million times 1 minus the tax rate. You'll get the same answer. But the problem is you have to calculate the tax rate first. And the way that you do that is you take the taxes that you had to pay as a percentage of your income before taxes, and that gives you the 35%. Okay? So this gives us our NOPAT of $7,085,000, and then we have to calculate our invested capital by taking the $97 million minus the $3.2 million, which gives us our $93,800. This is our invested capital. We take this divided by this, and that gives us our return on investment of 7.55%. Now, interestingly, we were given the cost of capital of 10%. And so we can kind of comment on how well is this division doing. And you can see that they're not actually performing to what they should. The cost of capital, we want to earn 10%. This is our required rate of return, but how much are we actually earning? Only 7.55%. Okay? So we're not earning the cost of capital. The next problem that we're going to look at, which is I asked you to do, was our Catherine's Department Store. Okay? And so this one had our net income of $6 million, interest expense 2.25, and here I give you the company's tax rate, total assets of 80 million, non-interest bearing current liabilities of 6.7 million, and our required rate of return is 10%. And this one I'm asking you to do NOPAT, invested capital, also calculate, and then also just calculate our residual income. Okay? So in this case, we'll come over here, and we'll say we have to calculate out NOPAT, so then we have to take our net income plus our interest expense times 1 minus the tax rate. And again, what you could do is you could have done net income plus interest expense minus the tax savings, which would be 40%, which mathematically is equivalent to just saying times 0.6. You take our invested capital assets minus our non-interest bearing current liabilities. This is our NOPAT. That's our actual NOPAT, and then you have to calculate the required profit, which is equal to the cost of capital times your invested capital, and you can see we have a 20,000. We have a positive residual income.